All right, class, as promised, we're going to talk about um, chapter 12a. So we're going to look at the first part um, of chapter 12, which is investments. So, big question, why do corporations invest? So when corporation they're going to invest in debt or stock most commonly, and these are securities, and generally it's for one of the three reasons. So the big one is they have excess cash. So there's excess cash laying around, which is not really uh, getting a return. It's not earning anything, right? So the as a good steward uh, of the company's resources, you want to make sure that that money is actually earning as much as it can. So that's one of the reasons. There's excess cash. Um, the second is to generate earnings from investment income. So I think this is really to be careful with this because you have to think a corporation may be in business for one thing, and it's not necessarily in an investment business. But definitely you'd want to um, generate some type of earnings from this excess cash, from this money that's being invested in debt, or equity or stocks. But that's not necessarily the operations of the business. And then the third is for uh, strategic reasons, for a purpose, for a plan, right? So when we look at this illustration, we're looking at really the operating cycle of the business. So if we see there, we've got definitely everything is starting with the cash, and then that cash is buying um, it's going and it's buying inventory, right? So we're moving to the inventory, and then from that inventory, we've got accounts receivable. So these are credit sales, right? Those receivables are paid, and then we receive cash again. So then if there's anything excess, right, we could put that into some type of investment, right? So we purchase, right, that investment, so we're paying out cash in exchange for that investment. We sell it. So we sell that debt, we sell that equity or that stock, and then we're going to receive uh, cash again, right? Which goes back into the whole operating cycle of the business. Now, when we talk about debt investments, uh, we're we're talking about bonds typically, and when we look at bonds, we're looking at either um, debt from a government, so a municipality, so it could be a city, could be a state, right? Could be any type of government entity. When we look at corporate bonds, we're looking at businesses. These are businesses that we're actually lending money to. So when we're doing the accounting for this, we're making entries when we acquire the bond, when we receive interest revenue. And remember, interest is what? The cost of money. And then also, if we're selling it, we're making um, a entry or record for that as well. And then when we're acquiring the bonds, all of the costs, so any type of fees for the brokerage fees that we may have, um, which can include some type of commission to purchase these bonds, that's included in the purchase price. So we need to take that into account as well with bonds. Now, when we're recording the bond interest, we've got some key points here. We get the carrying value of the bond, we multiply that by the interest rate, and then we've got times a portion of the year the bond is outstanding. So these are the 3 points when we're calculating and recording interest revenue um, for a bond. Now, if we're selling bonds, we're going to credit the investment account for the cost of that bond, right? So that's going out. Then we're going to record any gain or loss. So there might be a gain or loss on that sale. So any difference between that net proceeds from the sale, right? So that you've got the sales price less any brokerage fees, because there more than likely will be some type of cost to sell it, and then the cost of the bonds. So these are the points to keep in mind when we're recording the sale of the bonds. So let's take a look at this. We've got the Cool Corporation. They're acquiring 50 Doan Inc. 8% 10-year $1,000 bonds on January 1st, 2015 for $50,000. Okay? Now, this is the entry to record that investment. So let's dig deep into this. Cool Corporation, they're the ones, they're purchasing 50 of these bonds, right? 50 of the bonds. So, and the each bond is $1,000. So that's the amount of the bond. Now, they're paying, each of these bonds are paying 8% interest, right? They're paying 8% interest. So conveniently, this is done on January 1st. So we see here the entry for this. We've got our debt investments. We've got a debit to debt investments. So we've got a debit to debt investments, and then we've got a credit to cash. So we've got a debit to debt investments. So our debt investments are increasing. Our cash is actually, it's going out, right? So we've got a cash outflow because we're purchasing $50,000 worth of those bonds. So let's take a look at this. So now this is when interest is being received. So Cool Corporation, they acquired those 50 Doan Inc. 8% bonds, 10 years. So they mature in 10 years. 10-year $1,000 bonds. That was done on January 1st, 2015 for $50,000. Now, key point, the bonds pay interest semi-annually. That's every 6 months. So on July 1st and January 1st, right? July 1st and January 1st. So now we're going to record the entry for the interest. And like I said, conveniently, the purchase was done on January 1st. So now we look at this, we've got a cash inflow, right, which is that interest, which is $2,000. So we've got a debit to our cash account for $2,000. Then we've got that credit to record that interest revenue. This is interest revenue. Remember, interest is the cost of money. So we've loaned out $50,000 to Doan Inc. In return, for 10 years, we're being paid, right, 8% interest, right? We're being paid 8% interest. We're loaning that money for 10 years. That's the agreement for 10 years, right? And then at the end of that 10-year period, we get back our $50,000. But between that time, we're being paid 8%, which is the cost for Doan to use that money. Now, if we look down here at the bottom, this breaks down how we got that the $2,000 in interest revenue right there. So that 50,000 times 8% times 1/2, 0.5, that gives us the 2,000. So let's keep going. This is really interesting. So now let's look at, if Cool Corporation's fiscal year ends on December 31st, right? let's prepare the entry to accrue interest since July 1st to December 31st, right? Now remember, it's paid out on January 1st. So let's take a look at this. So we've got interest receivable. So it's receivable, right? It's due, right? We've got interest receivable on December 31st of $2,000, right? Interest revenue. Now let's look at this. On January 1st, we've actually getting paid that interest that's receivable. So what happens? We're going to debit the cash account, right? And then we're going to credit interest receivable because we're not waiting for that interest to come any longer, right? Because we've received it. So we've gotten the interest, we've got the 2,000 cash when it's paid out on January 1st. These are some great examples. So now let's assume that Cool Corporation receives net proceeds of $54,000 on the sale of the Doan Inc. bonds on January 1st, 2016, after receiving the interest due. Now let's look at the entry to record the sale of the bonds. Remember, so Cool Corporation purchased the bonds. It was January 1st, 2015. So they had the bonds for 1 year now. And the next payment is January 1st, 2016, but they've decided to sell the bonds and they're going to receive what? $54,000. Remember, Cool paid what? $50,000 for the bond. So let's look at this. We've got cash coming in of $54,000, right? So that's recording what? Oops, sorry. That's I'm writing the debit twice. So that's actually recording the cash inflow, right? Now, we've got our debt investments. We paid $50,000 for it. So that didn't change. So that's going out. So we're closing that out for the $50,000. We're moving that $50,000 out. We're bringing in that $54,000 of cash because that's actually what's coming in. But we've got a gain on that sale. So we're recording that. So we got a gain on the sale of the debt investments of $4,000. So the cash is coming in. We paid originally $50,000 for these Doan Inc. bonds, right, last year on January 1st, and we've got a gain. So it's a good thing. So we've got a gain of $4,000 on that sale of the bonds. Very interesting. So let's take a look right now at accounting for stock investments. Accounting for stock investments. So we're going to look at some methods that are used to decide ownership when we're looking at ownership percentages. So we've got the cost method. So if you're actually purchasing, remember when you're buying stock, that's equity. So equity is ownership. So if you've got from 0 to 20% ownership of a corporation, you've got that stock, 0 to 20% of that corporation stock. That's the cost method. And what's behind that, when we look at this, that means that your company actually has no significant influence over that corporation because you've got less than 20% or less of ownership. Now, and you'll use the cost method, and we'll look at that. Now, when we look at the equity method, we're looking at if you're, above from 20% on up to 50% ownership. That means that there's really some type of significant influence that's being exercised over this other organization, this other corporation. So then the investment is valued using what's called the equity method. And when there's 50%. So that's a majority, right? Control is usually existing, right? So it's 50 to 100%. You're looking at control. We're looking at consolidation, right? We're not looking at the cost or the equity method, because that's really, you've got pretty much control over that organization. What's key to note is that we use the accounting methods based on the investor's influence, right, over the operating and then the financial affairs of that corporation, of the issuing corporation. So that's key. Keep that in mind. So here's some bullet points just to cover the points on um, on the cost method. So remember, it's a holding of less than 20%. You're going to use what's called the cost method. Now, the investment, it's recorded at its cost. Any revenue is recognized only when cash dividends are received. Now, remember what dividends, this is a share in the earnings of the company. Um, and then costs include all expenditures necessary to acquire. So remember, there may be some type of brokerage fees, or any type of commissions that are there to actually buy the stock. So that's all included in the cost. So let's take a look at this. Um, when we're looking at this illustration, we're looking at the acquisition of stock investments. So we're looking at equity, buying stocks, and it's a holding of less than 20%. So we're looking at the cost method. So on July 1st, 2015, Sanchez Corporation acquires 1,000 shares, so that's 10% ownership, of Bill Corporation common stock. Sanchez pays $40 a share. So let's look at this entry and how we'll record it. So on July 1st, we've got a stock investment entry. Again, that's a debit, right? And then our cash is coming out. We've got a credit for $40,000 for this purchase of this stock of Bill Corporation. So let's take a look at the dividends. So during the time Sanchez owns the stock, it makes entries for any cash dividends received. So if Sanchez receives $2 per share dividend on December 31st, let's look at the entry. So of course we've got an increase in our cash position. So the next, we've got our dividend revenue, right? This is dividend revenue. So this is money coming in as part of a dividend from that stock. So we've got a debit cash for $2,000 and then a credit for dividend revenue, $2,000. Let's take a look at recording the sale of this stock. So assume that Sanchez Corporation receives net proceeds $39,000 on the sale of its Beal stock on February 10th, 2016. Now, the stock cost $40,000. Sanchez incurred a loss of $1,000, right? The entry to record the sale is as follows. So what do you think this could be on February 10th? We received that cash of $39,000. That's right. So we've got a debit for cash for $39,000. We've got a loss on sale as well of $1,000. So that's a loss on sale of stock investments. And remember, that's not changing. The stock investment was $40,000, right? We paid $40,000 for it. We've got a loss on that sale. So we've got that debit for cash for the $39,000 received. We've got a debit for that loss of $1,000. Then we've got that credit for the $40,000 stock investment. So let's look at this. We've got a holding between 20 and 50%. So this is the equity method. Remember, investor records the investment at cost, and subsequently you adjust the amount each period for their proportionate share of the earnings and losses. So we've got proportionate shares and any dividends received, right? Let's take a look at this. So now we're working with Milar Corporation. That acquires 30%. So we're just over that 20% number. The 30% of the common shares of Bet Company for $120,000 on January 1st, 2015. Everything is on January 1st. I really like this. Now, for 2015, Bet reports net income of $100,000 and it paid dividends of $40,000. Prepare the entries for these transactions. So remember, Beck, they've got a net income of $100,000. They paid out a portion. So the owners, the investors of the company, the shareholders are getting a share of that net income, right? $40,000 worth. So let's take a look at these entries. So we've got our stock investments, January 1st. That's $120,000, right? So that's increasing. You can only guess what's going to decrease, right? It's our cash, right? We're going to credit our cash for $120,000 for that stock investment. So let's take a look at this. We've got stock investments. We've got $100,000, right? Times 30%. So remember, we've acquired 30% of the common shares or the common stock of Bet Company. So we're breaking this down. This is the equity method. So we've got 30,000 December 31st. Revenue from stock investments is $30,000, right? $30,000. Now on December 31st, let's take a look at this. What happens? We've got cash. So cash is 40,000 times what? That 30%, right? And remember, they paid those dividends, right? Of 40,000. Paid the dividends of 40,000. This is how we record for the equity method. So we've got our stock investments, credit that 12,000. Our cash, we've got what? 12,000 coming in cash through the dividends of 40,000. That's how we get that calculation through the equity method. It's really interesting stuff. So let's take a look at this one. So Millard Corporation acquires 30% of the common shares of Bet Company for $120,000 on January 1st, 2015. For 2015, Beck reports net income, again, of $100,000, paid dividends of $40,000. Prepare the entries for these transactions. Now, after Millard posts the transactions for the year, its investment and revenue accounts will show the following. So let's look at that. We've got our stock investments. End of the year, we've got a what? We got a debit balance, 138,000, right? 138,000. And then we're looking at revenue from stock investments. We've got 30,000, right? We've got 30,000. So that's showing, right? We received what? What did we receive from that? So it's showing that we received, let's try that. Well, I can't take it back, but that's increased to 138,000 by the end of the year. And we are at the end of our lesson for today. So continue to stay diligent on chapter 12. It is some very interesting material. We're really talking about investments. Still, this is debt and equity. We're looking at both of them, how to account for it, but really how it works. So this is really great. Let me know if you have any questions concerning this. Otherwise, great job. Keep reaching up with it.